Simple but effective parabolic star trading strategy? Yes, this is a strategy we are going to backtest today on this channel. If you are new on this channel, today I'm going to backtest it and revealing you the real average success rate of this strategy. I'm going to backtest it on years of data and years of trades. And then I will try with my statistic analysis skills to improve the strategy and revealing you the real average success rate with all the improvements. So stay until the end of the video in order to know how this strategy performs. So let's talk about this strategy. I'm going to backtest it on these forex symbols and on the 30-minute time frame. Here are the other settings that I used for this strategy. For example, leverage 50 or alpha confidence interval 0.01. Okay. Now it's time to talk about it. Let's watch together some examples. I made some changes from the default strategy showed in this video because I found that some improvements can be made already without using statistical analysis. Okay, let's talk about the indicators you will need. Two indicators. The first one, parabolic SAR, is this indicator. And then you will need EMA, and it is this indicator. You will need these settings for a parabolic SAR, and for a EMA you will only need the 200 EMA. That's it. The strategy is really simple as the video says. Okay, now let's watch this trade. In order to open a long position, you have to check that you have at least 3 candles above with their close above EMA 200. Here it happens. And before, at least one must be below. In this case, this one is at least one below EMA 200. And then you have to check that these blue dots of the parabolic SAR go from above to below the candles. Here it happens. You can open your long position and the last close, setting your stop loss to the parabolic SAR. You will exit when the parabolic SAR dots will go above the candles. Here it happens, and so you will exit here. There is not a fixed risk to reward ratio on this strategy. As you can see now is 1.65, but it depends when the blue dots goes above the data. So pay attention that I personally don't really like strategy with not fixed risk to reward ratio, but maybe this strategy has some potential. Let's see a short one. Okay, in order to open a short trade, you have to check for at least 3 candles below EMA 200 with their close. Here it happens, and at least one in the last 10 about above EMA 200. For example, this one is okay. Then you have to check that the blue dots goes from below to above. Here it happens. Only one dot, but the strategy is this one. So you have to check for the switch of the dots. You will set your stop loss at the parabolic SAR, and you will exit when the dots will go below the data. So you will exit here. As you can see, risk to ratio is 0.86. Let's see last trade. Okay, as you can see, blue dots below, then blue dots above. We can see at least 3 candles below EMA 200 and at least one in the last 10 above EMA 200. Then you can open your short position the last close, and you will exit when the blue dots will go below the data. Here it happens. So risk to ratio 1.95, 91 in this case. So this strategy seems to be profitable. By looking only at 3 trades and showing you only a few trades is what many YouTubers do on YouTube. They only show you a few trades. It seems the strategy is really profitable. Then when you try to backtest it, you see that just after, let's say, 50 candles, 50 trades, the average success rate you have, it's not quite near the one they show on their channel. Okay, but now I only shown you 3 successful trades. Let's see if this strategy is really profitable or not. As you can see, these are the results on over years of data. As you can see, 53 is our success rate. We have like 1000 trades, not a good number, but not a bad one. So it's pretty good, but not so bad. Okay, it's not pretty good, but not so bad. It's not statistically profitable. As we can see, our lower confidence interval doesn't go past 50. And as you can see, also the software tell me that. Then we can see also that a big spike on the balance chart. As you can see here, you would have gained like 10% of your starting account by risking only 1% of your starting account. So what does it mean? It means 10 to 1 risk to reward ratio. One trade was 10 to 1 risk to reward ratio. It seems pretty good. It's a huge profit, but as you can see, there are also a big number of fails, small fails, because sometimes you will not the price will not hit your stop loss, but before you will exit because the blue dots change if they are up or down, but they are not completely fail. So you would have not lost 1% of your starting account, because if you're new on this channel, I remember you that each trade is risking 1% of my starting account. So as you can see, there are many fails in a row, small fails. I would not say there's many failed trades in a row, but many orders fails, because an order can be associated with a completed trade or not. Half a trade, 1/3 of a trade. It depends when you exit and where you place your stop loss and take profit. Okay. After saying that, I think it's time to improve the strategy with statistical analysis. But before doing that, I always remember you that you have to check if the strategy is not overfitted yet. And how you can do that? You have basically to check. You have to try. Let's say you backtest it on 3 years of data, and you obtain an average success rate with a confidence interval. Then you try to backtest this strategy on the last years of data, and this average success rate on the last years of data will be your test dataset average success rate. As you can see, our test dataset average success rate is 52. And this is the last year basically of trades, and it's in the confidence interval we have calculated before. It's located here, so we can say that. So we cannot say at 99% sureness that these two average success rate are different. Okay, now after we have said that, it's time to improve it, and let's see if we can make some profits. First of all, the first thing to see is if there is any difference between buy trades and sell trades in terms of number of trades, and also in terms of average success rate. As you can see now, it performs better on sell rather than buy. Then let's try with a criteria to improve it, and let's say that today our criteria will be MACD crossover. And what I have found that if you have checked for a bullish MACD crossover, if you don't know what is a bullish MACD crossover, it's plenty of videos on YouTube, on internet, in which you can check it. But if you are familiar on this channel, I showed on this channel many times what is a MACD crossover. So check other videos, maybe on MACD, and surely you will find something about MACD crossover. But let's focus on this analysis, and I have found that if you have checked in the last about 10 candles for a bullish MACD crossover, the new average success rate would have been 57%, and for sell would have been like 56%, but the number of orders would have been half than before. So maybe new position will be opened by running again the strategy on the train dataset. So we are expecting like an average success rate of 56, 57. Maybe it will be quite different, or it can be good, or it can be worse than the one we are expecting. But the only thing to do is to run again the strategy. Here you can see all the code I wrote for this strategy. So here I'm checking for EMA 200. Here for at least one candle in the last, from the last 10 to the last 3 to be above, to be below, either close below EMA 200, because here we are analyzing the buy case. And here we can see the MACD crossover criteria. I have already added it. Here the condition parabolic SAR. So 1 stands for up and -1 stands for down, so below the data. Here we can see the dynamic backtest order I created with all the formula. So it will be the open price will be the last candle close, the stop loss price will be the last parabolic SAR value, and the take profit condition to exit is when the current candle parabolic SAR will go below the data. And also I'm applying the stop loss condition. So we have a take profit condition and a stop loss condition, and it is this one. Okay, here we can see the call for sell, and it's the opposite one of buy. Okay, after showing you that, it's time to run again the strategy, and let's see how it performs. Okay, as we can see, 54 as our success rate. It's not 56 as we predicted, but as we can see, we would have expected like 300 trades, 300 orders, and now we have 500. So that's normal. 200 trades, new 100 trades were opened. They didn't perform so good, and the average success rate now is 54. It's higher than before. Yes, it is. How much trades we have lost? Like half of the trade, and we have made more profit or less profit than before. As you can see, here the average success rate without commissions, and here the other one. As you can see, here is higher, and with commissions it's almost similar. So it means that this was not a good improvement. I would not say that, because surely the new average success rate is higher, and we have not run it on the test dataset yet, but probably better filter can be applied. Yeah, I think so, because losing half of the trades in order to gain only 0.5% of your 0.5 percentage points, it's not such a good improvement. But probably but we can see also that the commissions, it's almost the balance with commissions, it's almost similar to the one on the train dataset. Why it is happening? Because probably we are needing less buying power than before, and by needing less buying power as before, commissions are smaller. If you don't know, on Forex many platforms apply you commissions based on how much buying power you are using. So it's also important to pay attention to that. Okay, but after saying that, it's time to check that these improvements, it's a really good one. Also, as we can see, the strategy is not statistically profitable, but we have to check that we have not overfitted it, because an improvement without checking for overfitting is basically useless. So let's run again the strategy on the test dataset, and let's see the new average success rate on the test dataset. Okay, as we can see, 55%. Here was 52. So good improvements, 3 percentage points. That's good. But the most important thing is to check that the strategy was not overfitted. So let's check that this average success rate is in the confidence interval. Yes, it is. So at 99% sureness, we cannot say that these two average success rates are different. So basically, the average success rate in train and dataset are not different. So we can say that we have not overfitted the strategy. Although this strategy is not statistically profitable. But good improvements, I would not say good improvements, but you would have made some profits. Okay, but before ending this video, I want to remind you that these are not financial advices. I'm not a financial advisor, and I'm not responsible of any use of this strategy or other strategies showed on this channel. Make your own consideration, trading is very dangerous, and pay attention. But if you enjoyed this content and this deep analysis on this strategy, I remind you to leave a like, leave a comment, subscribe, and see you in other videos. Bye!